One. Welcome everybody. This is Brian Downing. We have Dr. Paul Cottrell online who's going to be presenting his utilizing topographic finance to understanding volatility. Go ahead, Paul.
Hello. I'm going to be presenting this paper that was released maybe 2 weeks ago. It was published on ssrn.com, and you can easily download it, or I believe I also put a link in the Meetup. And my co-author is Francesco Angulo, and he's my research assistant. He's in Milan, Italy, and we collaborated on this paper. This is our first collaboration, and we're collaborating on another paper that's related to the bond market. So I'll present that, after we write the paper, maybe in a few weeks or so. So the purpose of this paper was to explain, at least academically, and publish it academically, and how to read three-dimensional surfaces, volatility surfaces, that are a little bit different than the normal option volatility surfaces. So the people that know me and the stuff that I've done in the past and stuff that I presented with Brian last year, I look at the market in 3 dimensions, and this paper is to really explain how to do, how to do it, how to read it, and what can be learned from it. So this is an empirical analysis of the S&P 500 and the 10-year treasury rate and the oil market. We used 85 samples, daily closing observations. Normally I parameterize the surface with 90, but in this study we used 85. And the purpose is to show the visualization of volatility in these different markets. So just speed through here a little bit. Part of the reason why we need to look at volatility surfaces is due to the fact that I come from the perspective that price curves and time curves, your typical price curve that you're looking at during trading, there's not enough information on there, that there's something hidden in the price. And I believe that by looking at volatility in 3 dimensions, that you'd be able to understand a little bit more about the price dynamics. So our data set that we used was from November 10th, 2014 to February 27th, 2015. And we picked 85 because it's roughly in the center of a 60-day surface window and a 90-day surface window, which is typically what I parameterize the surfaces when I look at the market. But because I wanted to make a simple paper on how to read the surfaces and understand how to read the surfaces, I wanted to make a simple paper, not something that was 30 pages long. So we just picked the mid-range. And what we look at in terms of dimensions is time for the X, drift for the Y dimension, and volatility. All right, now the literature review. In the literature review for this paper, it was a small literature review. I quote, or I cite Soros in his book on the alchemy of finance and how he uses notation to describe the currency market dynamics. But his book doesn't really give insight on how to mathematically define behavioral economics or the reflexivity principle that he's somewhat famous for. He just provides some sort of notation to understand those dynamics. So the problem with Soros's book is that, how do you really understand the market more from a quant point of view instead of more from a notational point of view? Then we cite Thaler, and he's kind of known for behavioral finance. And so there's a lot of literature out there in behavioral finance and how to model rational actors or rational traders and irrational traders and the dynamics between them. Here's a formula that defines the rational trader in Formula 1 and the irrational trader in Formula 2. But we don't really go in this paper. We're not really, going in depth in Thaler's formulas. But the point here is that there are formulas out there to define fundamentalist traders and chartist traders and how they interact in the market. But still, it doesn't give you. They're good for theory. They're good for economic theory, but they don't really help you with trading. Schiller wrote a book. I think it was called The Irrational Exuberance. Not positive about that, but with Schiller, he's also a behavioral economist, and he's known for the idea that the market isn't efficient, that there's inefficiencies, and that there's these herd effects, and that you might have rational traders, but the irrational traders entering the market or exiting the market quickly adds to a lot of the volatility, the price volatility, and that's really what's driving the price. So with what Schiller's saying, it leads credence to what we're presenting, looking at volatility and surface volatility to understand price dynamics. Then the famous Black-Scholes paper that came out in 1973. Their paper was primarily for option pricing. But the idea is that there is a Brownian motion system to the market or to assets that are sold in the market, and that there's this drift and volatility parameter within the Black-Scholes model. So we take a little bit of the Black-Scholes model and the Brownian motion aspect to it, and say, well, by seeing a change in the actual asset price, the price of the system, it's equal to the drift times the current price plus the volatility times the current price plus some stochastic process, or what's called the Weiner process. So what we're doing within the surface model for these 3D surfaces is using this drift parameter and using this volatility parameter. Now, the surface method, the surface fitting method that we use is what's called a biharmonic spline interpolation method. This can be used in MATLAB under the curve fitting toolbox. And then I cite some of my research mentioning how that you could understand the market and its state spaces and the probabilities to improve forecasting through volatility using the receding horizontal control and stochastic programming method. That's part of my dissertation. So the methodology that we used in this paper was a longitudinal study. So it was cutting through time, cross-sectioning through time. It was 85 daily closing prices of different markets, the S&P 500, the oil market, and the 10-year Treasury. And we surfaced each of those markets with the biharmonic interpolation method that I mentioned. And let's see here. Operational definitions. Everyone pretty much knows what the S&P 500, the WTI is, and the 10-year. All right, the data. Okay, what we did was we pulled the data, and this is a good source. This is a good source for anyone that wants to get at least daily data, econometric data, or monthly data. I like using the Federal Reserve, the St. Louis Federal Reserve, or what is called the FRED, F-R-E-D database. It has a lot of resources. It's not just trading type resources. There's a lot of econometric type information, and I think Brian also uses it too.
Yep.
But I like the resources that they have. So we pulled the data from Fred, and they were all daily closing prices for each of the time series. What was actually pulled down from Fred was from November 3rd, 2014 to February 27th, 2015 for the S&P 500, the 10-year Treasury, and the WTI oil. Now, we end up only using 85 observations. Part of the reason for that is that the surfacing is actually parameterized using a 5-day window. There are cases where I've used larger windows for larger studies, but I find for trading, at least at the day level, that a 5-day moving window is good. So we used a 5-day moving window, and that's why we had to truncate the first 5 closing prices in the data set. So we ended up starting with November 10th instead of November 3rd because of the 5-day moving window. So we have a 5-day moving window for volatility and a 5-day moving window for drift. We assume that drift is calculated using a regression line. So it's a quick way to get momentum, momentum direction. Now there was a few days because of either holidays or some data that was missed within the data sets, and we handled those by taking the price before and the price after the missing date and just took an average between them to fill the missing data points. Okay, for the surfacing part of it, we use MATLAB. We use the curve fitting toolbox, and we loaded up each of the data sets into the workbench, and by going into the curve fitting toolbox, you can define your X, your Y, and your Z axis. For us, we define time as X, drift for Y, and volatility for Z. And you select the biharmonic method for the surface fitting. So by doing this, you get 80. Is it 80 or 85? I think it's 85 observations out of the 5-day moving window. And you have a volatility surf for each of the different markets. This chart here is the actual data before it's surfaced, what to describe the actual data set. So here you can interpret for the S&P 500, the max log return, 0.024, minimum, max, min, mean, median, standard deviation, variance, the kurtosis, the skewness, to understand the actual data sets before they were surfaced. Now the results. So again, this was from November 10th to February 27th, 5-day volatility drift and 5-day volatility and drift with time as the X. And let's see the figures here. So the S&P 500 index. Okay, this is really the meat and potatoes of the lecture here, right here. Okay. Let me get there. There we go. Okay, here we go. All right, this is what a surface looks like after you surface fit data. You have here the actual time. So each one of these is a time. This is times 10 to the 5th. So this is kind of a MATLAB's notation for time. This is earlier in the data set. This is later in the data set. So this is the most current within the data set. This is the oldest back here. Here's the drift, the 0 point. So here's anything below 0 is obviously trending down in drift, and anything above 0 is trending up. And then the volatility, and this is measured in standard deviation. So what you have is it's always going to be positive, but you have this shape to understand the volatility. So what's interesting here is there's two things to keep in mind when reading these surfaces. One is the qualitative aspect and the quantitative aspect. Volatility isn't an exact science, so you have to do a mixed method to understand to understand volatility. So that's why I like to see it graphically, and then why I like to see the probability. So what we did was we calculated not just the surface, we also calculate the probability curves for volatility, the PDF curve and the CDF curve. I like reading it off of the CDF curve. It's just more natural for me. But if you're more used to looking at more of the PDF curve, you could do the same thing. So this is the quantitative measure. This is really a qualitative measure. So this qualitative measure for the S&P 500 is just showing, well, you have two major peaks in this time series from November 10th here to February 27th, 2015. And in between that data, you had two major volatility peaks, and this kind of like this wave pattern. And at this data set, you see that it's in a lull period, and you notice, from a qualitative perspective, that volatility peaks and then volatility goes down pretty quickly. So what you're seeing here graphically is the heteroscedastic properties of volatility. And it stays in the lull period, especially down here, for a little while before it comes up. So just by looking at the graph here, you know, as I started working with surfaces and trading with them, you get kind of used to certain properties and what to look for. So the first thing I see, when I look at a surface is this: am I in a peak or am I in a trough? Right? And if I'm in a trough, then I know that I'm going to be in a trough for a little while, qualitatively, before it starts to peak up again. And most people that look at volatility curves, they have that sense. Now, that's not a scientific thing, but you'll see that by going into the quantitative data, you'll see that it becomes more scientific. And if you're at a peak, then it drops down pretty quick. So in this data set here, just by looking at just the volatility, I know that there's a higher probability that I'm going to stay low in the volatility range in this state space, this volatility state space, for a while before the volatility is going to start peaking. At least the probability. So the basic rule when you're looking at the surface is that if you're at a higher point, the volatility is going to start dying down. If you're at a low point, it's going to stay. The probability is that it's going to stay low for a little while, and as you stay low in that trough, the probability of it starting to peak increases. So it's almost kind of like the opposite. So with that in mind, you take a look at the CDF function, and the CDF function is basically saying, okay, well, if I am in a low period, in a low volatility environment, like this is, a normal reading of the CDF function would be, let's say this was at 4. So if it was at 4, I'm reading off of here, that there's about a 0.4, so about a 40% chance of volatility being lower than what it currently is. That's the typical reading of that. Or a 60% chance that the volatility will be higher. But we know qualitatively that that's not true. That it has to be in the trough for a while before that 60% is valid. So one of the heuristics to reading a volatility surface is that if you are in a trough like this, that you need to invert the CDF function. And what that basically means is that if you are at 0.4 down here, then what that means is that you read the CDF, and a typical reading would say, well, 60% chance it'll be higher. What you want to do is invert that and say 60% chance that it's going to stay in that range, and only 40% chance that it's going to go higher. But as time goes on, there is a decaying function that's not presented in this paper, but I have some other papers that will present that there's a decaying function that as time goes on, this CDF function actually reverts back to the normal reading of a 60% chance or an 80% chance or whatever that the volatility is going to spike. Now, if you were at a peak, let's say it was at 10. Let's say this data wasn't existing and we were at a peak and it was at 10. We would read that the typical way. We wouldn't invert the CDF function. We'd actually read the 10 and see, oh, it's roughly 90% chance that it's going to go lower, and only 10% chance that it'll go higher. So when you're at a peak, reading the CDF function in its typical form is very, very accurate. It's a little tricky when you're in a trough because of the unknownness of volatility. Reading to get a little bit more accurate. But really, the proper way to do it is actually having a decaying function. It's inverting the CDF function and having a decaying function over time. That's the proper way. But most people, being quick and dirty, you could parameterize the surface, calculate your PDF and CDF functions, and then look at it. So in this paper, we're only showing the probabilities of the volatility. But what you really want to do in trading, and the reason why we didn't show it in the paper is just for space. But in trading, what you really want to do is also create your CDF function of your drift. So by looking at the probability of drift going up or down, and the probability of volatility increasing or decreasing, you can place a momentum trade in whatever commodity that you're looking at. So now let's take a look at well, before we look at the next commodity here, I have a summary in the paper that has how to read this. So the conclusion here is final analysis. Okay, and the final analysis, the volatility of the S&P index for February 27th, so the last data point, is relatively low compared to the volatility epochs in the middle of the time series. With such low volatility, the CDF curve suggests that future volatility will have a higher probability to increase. Remember that increased volatility means a change in drift or a change in returns of a position in the asset. This is a good point to place a short or long in the market relative to a 80-day surface window. A high probability of positive drift will lead to the decision to long the market when coupled with lower current volatility. The negative drift is more probable with lower current volatility. Traders should short the market. So this paper is kind of like explaining how to long or short the market based on the CDF function and the surface. Now let's take a look at the 10-year treasury within the time series. So we did the same thing for the 10-year. And okay, so this is the 10-year. And it has some characteristics, qualitative characteristics that are slightly different than the S&P 500. You notice with the S&P 500, it was more down, up, down, up, down, but it was pretty much flat, it wasn't trending up or trending down the volatility. What's interesting here is that the 10-year treasury is trending up. If you were to do a regression line here, but the volatility is actually trending up. And this surface gives a little bit of credence to the idea that there's more volatility in the bond market, probably because of the exit strategy of the Federal Reserve. So this is kind of a qualitative hint at a higher future volatility overall in the bond market. Now, qualitatively, you have these undulations, the heteroscedastic properties of volatility, so that makes sense. You have your time. Down here is your February 27th. Here's your drift. You got your volatility in your Z. And your data points here are the actual what actually took place in that day, what the volatility was and the drift was at that point in time. Remember, we're using the Black-Scholes parameters as variables in the surface. So here, I think it's this point here, if I remember right, that's the oldest point. So if that is the case, then you have a higher drift and you have higher volatility. And looking at it qualitatively, it looks like volatility might be going a little bit higher before it starts to drop down. So it hasn't reached its inflection point yet. So in that case, remember what I said, if you're near the point of a top, you want to read the CDF function like you normally do, not when you're in the trough or in the invert. So in this case, it drift looks like, let's just say 4, maybe 0.035. I'm not sure. I think it's 0.035. So if I take 0.035, go all the way up, I'm at already more than 90% chance the volatility is going to go down. So this is a good reading here that, well, because it hasn't, because of the way these surfaces interpolate between the points and extrapolate beyond the points along this edge. Short term, in this data set, the volatility was going to increase, but not for much longer, and then it's going to decrease. So in this case, this is approaching the point where you might want to short volatility, not long volatility. And according to the probability from the data that we had for this surface window, it has more than a 90% chance of actually going down within a 5-day period. So that's how you read that one. But what is interesting, I think, is that you have this trending of the surface. The volatility is trending upward. And that's indicative of probably the market, the bond market, becoming more unstable because of the Federal Reserve. While you have the S&P 500, the S&P 500 here, I can get there. It's a little bit more, I want to say, it comes down, up, and then comes down, but there's not like an overall, it's probably almost like flat, maybe a little bit downward, but not, it's more flat than this surface here. But you can also look at the skewedness of the PDF function. This is part of the reason why you want to look at PDF functions. Look at this kind of the actual beta curve fit here on the data that we have for the S&P 500, and then keep that in mind. And then when we move to the bond market, by looking at the skewness of the PDF function, you can understand changes. So this is starting to look like a bell-shaped curve, right? So one property in finance is that you normally have skewness, where you have data that's the volatility data should be much more in density with lower volatility, and with really high volatility because of heteroscedastic properties, it should be more of a tail. So finance, in kurtosis. So you have this, normally you have that longer tail that you saw in the S&P 500. Well, the bond market, that's not happening. It's actually moving more towards a normal distribution. You can see here that the best curve fitting for this PDF function is actually a normal distribution. That's telling you that volatility density is increasing, which means that the bond market is going to move more and more volatile. And so you have a qualitative measure seeing that the surface is moving upward, and you have a quantitative measure showing that you have volatility within this data set actually moving more towards normal distribution, which is not a normal thing. This is telling you that the bond market is moving into a new epoch. That there's something, the system, the bond market is changing. That the players are changing their positions. And in the news today, I remember hearing on Bloomberg that the fixed income branch of, I think it was Deutsche Bank, that they were going to restructure and lay off a lot of people. And it might be due to what they're seeing here, that the fixed income market is radically going to, have some problems. But that's what this data set's showing. Bernanke was interviewed maybe, I want to say, a week ago or 2 weeks ago, and quoted as saying that they're still going to, bonds in the United States will stay with low yields. So, who knows? But the data is saying that there's a system change happening in the bond market for the 10-year. Now look at oil. Now oil is a big issue also because of volatility, right? Now this data set is from November to February, so it has some of the sell-off, the volatility and some of the sell-off that was happening in the oil market. But this data set is not capturing the full sell-off. The sell-off started before November. And what's interesting with the PDF function is you're also seeing the lack of skewness that you see in the S&P 500. The S&P 500 had a normal long tail skewness. Now, the oil market and the bond market are acting very similar. Their PDF functions, at least with this data set, is showing normal curve fitting for the PDF. And that's not a normal situation for most financial assets. So that's just meaning that volatility densities are increasing, and these two asset classes, the bond and the oil markets, are increasing in volatility. And we can kind of see that qualitatively with the surfacing. You have this kind of lull period and then this huge spike, relatively within this surface band. And here again, when you see high spikes, then it drops off. You have a lull period, spikes, drops off, spikes, drops off. So this is at least in this data set, is showing the volatility starting to peter off here. But this ends February 27th. Now, if you look at today, oil is somewhat stable now, relatively. It's in the 50 range now. A lot of people were saying back in February that, it might hit, the 35 range. So, at that moment in time, if you look at this surface, at least the 5-day moving window, you had a pretty good bet that the volatility was going to start dropping down. And this surface, at least in the near term, within the next 30 days or so, I would say volatility would remain low. And if you take a look at the points, I think maybe it's this point here. Maybe it's this point here, I'm not sure. That 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 are the last points in the data set. Volatility is somewhat lower relative to the peak, but the way the extrapolation of the surface is, you can see that it's still, volatility is going to stay, start to stay low for a little while. And I think that's what we're experiencing now in the market, in the oil market. But to read this, let's just say, .03, you're about at the 80% mark that volatility is going to go down. So that's somewhat indicative of the qualitative measuring or interpretation of the surface here. But long term volatility, this volatility density, this PDF, this is a little worrisome. You don't know if it's going to go back to its skewness. If it goes back to its normal financial skewness, then the oil market will probably be more stable. But if it stays in a normal distributed curve fitting for these different moving windows for these surfaces, then volatility is most likely going to start increasing. And if that's the case, then oil, there might be some ups and downs in the oil market. So that's basically how you interpret the surfaces. And before I take any questions, just to recap, it's this framework is really to understand volatility in different markets and to see it in, at least this paper showing it in the market and the volatility of the market through time. And you can utilize CDF functions to get a better understanding of the probability of a particular trade and how you might want to position yourself in the market. And to actually improve on, and this goes to Jason's question earlier before we started the meeting, that you can use the surfaces from a historical point of view, and you can adopt a Garsh method for projecting out certain periods, a 5-day period outward, a 10-day period outward, a 1-day period outward, however you want to parameterize your Garsh modeling method. So this sort of surfacing method works well with Garsh modeling. And here's some of the references that we had in the paper. And again, this is done by my research assistant Francesco Unglo and myself. And if you wanted to contact either of us, you can contact us through this email here, and I'll take any questions that you might have.
Thanks a lot, Paul. Dr. Paul, sorry. Anybody want to type up some questions in the chat box? Please go ahead. There's about 13 of us, so let's get some questions. I got a couple of questions for you, Paul, but we'll leave it to the end. Anybody got any questions? Don't be shy. No? I'm not seeing anything. Does anybody want to speak up? I can unmute anybody. Just type away in the chat box on the right. Anybody?
Yeah, Ron is here.
Yeah, go ahead.
Okay. In terms of mean reversion application, whether it's pair trading or volatility tendency to the mean, what are the cost-effective instruments that you recommend to protect against the movements? We usually were shorting volatility, but the volatility is going against us because of a political issue, like what happened on Putin when he attacked Ukraine. Volatility will shoot up, so going against us. What do you recommend in terms of cost-effective instruments for the commodity, for the equity, or for option? And at what leverage should we protect against such an event?
Well, it's based on your risk aversion, to answer that. I mean, if you're somewhat of a risk taker, then you don't want to hedge too much. If you're somewhat of a person that's more risk averse, then you want to be more heavy on the hedge leg. I'm a fan of dynamic hedging. Other people are not. Now, there's some people that may take a long position in the S&P 500, and if risk, if volatility, you got to remember that my definition of volatility in this paper is a little bit different than the VIX volatility. My definition of volatility in this paper could be positive or negative. It's just saying that the standard deviation from your log returns are going to increase. And by looking at the drift, you understand which direction that is. So if volatility is going to increase in the surface, and you have positive drift, a good probability of positive drift, it means that you're actually going to probably have a positive jump diffusion. That's what that stands for. If the market's trending down, you have a higher probability of a negative drift, and volatility starts to spike, then you need to protect for the downside risk. So you might have this, jump diffusion going negative on you, and then maybe some market mean reversion that's taking place. Now, in the case that you're longing the market, and let's say the surfaces are telling you, well, volatility is going to start spiking, and that, you know what, it's been too good for too long, and that there's going to be a little bit of a downside risk. All right, to hedge for that, many people will buy put and maintain their long leg in the S&P 500. So buy a put, and they'll get a little bit of an appreciation on it once the event takes place, and then you sell it on the event. You made a little bit of money, and you maybe do some dollar cost averaging back into the long position, or just keep it in cash for the next time where you need to protect for the downside risk. You don't want to protect for the downside risk all the time, because you probably lose money in the option market. Now, if you're in futures, I don't recommend putting money into futures. I call them naked positions. But the way to do it for futures is, I think, doing a calendar spread. Where if you think the market's going long, then you buy the the current contract, short the future contract, in time, farther out in time, and your leverage position is much less, because you bought a future contract and you sold a future contract. So the exchange says, oh, you don't need as much margin to maintain the future position. So I view spread, more or less the spread between the calendar spread as a way as a risk for risk management for futures. Now, currency is a little different. Currency
How
is,
about option volatility for people who trade mean on the S&P options? What instrument, cost-effective instrument, would you recommend?
all right, if you're going to be trading volatility on the S&P 500,
On the component of the S&P 500, optional component, and you believe that they will trade to the mean.
but give me an example. Play an example, and then I'll tell you how I do it.
Let's say I trade the long and the short on 300 option an option on the 300 of the components of the S&P 500. And I believe that right now it's a trading volatility. It will convert from 15 implied volatility to the 12. But I would like to protect ourselves against, let's say, a war in the Gulf that will spike the volatility within 2 hours to back to 20. Hypothetical scenario. So what is a cost-effective strategy to protect against such a big spike?
Yeah, I mean, you're talking about you're really talking about major option strategies to protect for a particular event in such a short amount of time. This is more like binary type option type stuff you're talking about.
Okay. All right. So basically, your hint is the binary is the best. Is the cost-effective,
right? Well, I didn't say that. I'm just saying that from your example, you're saying you're holding the position only in a few hours. Or are you holding the position for multiple days?
Multiple days.
Oh, multiple days. I thought you said a few hours. For multiple days, well, I would think that either a straddle or a collar is probably the best way to handle that. But I don't want to pretend. I don't want to portray that I'm the expert at complex option strategies. There are many more people that Brian knows that participate that are more on complex option strategies. I'm more futures and institutional investing, bond and equity, a little bit of the REITs and stuff like that for institutional investing, but complex option strategy that is not my specialty. And the point that I think the main point of this paper is that volatility surfacing is not just for options. It started in options because volatility surface was volatility with expiration and strike price, and the surface showed the decay of volatility. Now, by taking the Black-Scholes model and doing some surface, some biharmonic surfacing, and looking at the market from the perspective of drift, of log returns, and of standard deviations, and looking at it from probability curves, you could extract information graphically in a three-dimensional object that's similar to a volatility surfing the options market. But there's many different strategies that you could do to hedge against risk. It's not necessarily just in the option market. One way to hedge risk is that if you were to long the S&P 500 and you think that volatility is going to spike, and you're going to, and there's going to be some event risk that's going to take place, there's nothing wrong with actually buying a futures contract in the 10-year bond, because almost always geopolitical risk actually increases the value of the 10-year U.S. Treasury. So you don't have to necessarily do a collar or a straddle position in the option market. But that's just me. I view things more in the futures and currency and market than I do in the option market. I'm not an expert at complex option strategies, but my gut feeling is that, to answer your question short, in a short form, I think a collar is probably the best strategy.
Thank you for the answer.
And anybody else got any questions? Want to type them up in the chat? Anybody? Wow, quiet crowd. Go ahead.
If nobody has a question, I would like to ask you, as a practitioner, what would you like to advise us in terms of using this methodology in day-to-day?
Wait, are you saying that, are you asking me how I use this for trading?
Anything you can disclose that you feel comfortable to tell us or to educate us?
Well, the point of this paper is to show the academic part of this. I trade a lot. I didn't want to bring it. There's another forum that, where we have with Brian, that we talk about strategies, financial strategies, and, what individuals are doing. I'm not really prepared to say, okay, long the market at this price and short the market at this price for this.
Oh, no, that's not my question. The question is really, how would you use it on a day-to-day?
Oh, okay. All right. So I have a software called Poseidon, all right, that makes these surfaces and does some back-end stuff that's a little bit more advanced type stuff. And how I look at the market is that I look at the price curve, and I look at the RSI, and I look at the MACD. I look at the 50-day and the 50 period moving average and the 20 period moving average. And what I do is I parameterize the surfaces for a 90-day, a 60-day, and a 30-day window. And by looking at that, I get a feel for long-term volatility changing and daily volatility changing. So if I want to hold position for, let's say, for a swing trade, for a 4-day swing trade, a 60-day moving window is pretty good. If I want to hold a position for, let's just say, 1 day, I want to take a look at the 30-day actual parameterized surface window. So it's similar. You read the surface, you use the surface windows similar to how you would look at, let's say, a day chart, a 30-minute chart, 10-minute chart. It's in a similar context. So I look at the surface, I look at the CDF function, and I look at those technical indicators. And if they align a certain way, then I want to put it in a position. But to answer your question, I use surface modeling on everything I trade. I look at the volatility of the surface model. And I do it in the Forex market, and I do it
Whoa. You there, Paul?
Yeah.
Yeah, okay. Yeah, it just broke up. You all right?
Yeah, I'm here.
Okay, because we broke up for a bit. We just heard up until oil or energy.
Oh, I use the surfaces for the energy market, the oil and nat gas and the Forex market.
Any other questions at all? Ron, if you got any more?
Thank you for the answer.
I've got a couple of questions for you, Paul. I'll type them up in the chat box, if you can see them. It's just basically what I'm asking. Can this be applied to a faster time frame, like a 5-minute or 1 minute? And it can be.
I have. You can apply it to tick data.
Really?
Too. You can apply it to tick data. So what? In this paper, we're taking 85 points, right? 85 closing points. But there's nothing that stops you from taking just 85 periods, 85 ticks. or
Yeah.
85, you know what I mean? So it's really, the limiting factor is the speed of the tick and how fast the surface is parameterizes. Now, you can't parameterize a tick level surface, if it's a 120 day, 120 point moving window, because there's going to be too much latency. But if you do 30, then it's not. You can do the tick level.
Okay.
But I don't know if you really need that, because if you're looking at volatility, are you really trading volatility at the tick level?
No, I'm just more worried about the sensitivity of it. Meaning,
I think there's just too much noise in the system.
Exactly.
You
Yeah.
don't know what the truth
Exactly.
is at the tick.
Yeah, I realize that.
But could it? From a technical standpoint, can it be done? Yeah, it can be done.
Okay.
I don't know if it means anything from a trading point. I've always thought that the volatility surfaces work really well at the day level.
Well, I'm only bringing it up because when you look at something like, I've been watching the frequency of Bitcoin and how volatile it is, can be in such short time periods, that this type of framework would definitely be a good application for trading something like Bitcoin in real time, because the swings are just like fast and furious in amount of hours.
Well, the more volatile the market is, probably the more applicable the surface and the CDF function would be to the quant trading.
Yeah.
Yeah, I would agree with that.
Okay, that's good to know. Anybody else got any questions? I got a question for you on the outlook of things. Anybody else got any questions at all? Don't be shy, everybody. It's, so we can all learn here. Anybody? No? Let me ask you a question on the outlook. Paul or Dr. Paul. I've been getting a lot of alerts on the outlook of where oil is. You hear oil's still going to go down, oil's going to go up, oil's bottoming. The one thing that I've been hearing and hearing more of is that over the next couple of months, that oil's going to become probably a hot trade in terms of a couple of, basically a general trend up. But do you think that there's going to be a lot of volatility swings during that process?
Well, according to this, now again, my data set truncates at, February.
February, yeah, I realize, yeah.
If this maintains, if let's say I, redid the study and showed the latest data, and we still are seeing this sort of curve fitting with the volatility, then it's telling me that volatility is coming, it's going to be here for a while.
Okay.
If this starts to shift to the left, then it's going to go back to its normal state, where it's going to be more stable, maybe trend up. I don't think we're going to see $100 oil.
No.
Anytime soon. I don't think we're going to see $35 oil.
No.
But you might see, that $45 to $55, swing.
Right.
And that swing is, that $10 swing is going to give you that that volatility spike.
Okay.
So I think that volatility is going to still be there, and volatility's always been there in oil. But this to me is uncharacteristic of the normal state of financial products. This is usually saying that there's something changing in the system. There's intervention in the system. The players it's different.
Is that due to the fact?
In the bond market, because we saw the same thing in the 10-year bond market, I think what it is that you have central banks not intervening as much, and that there's going to be this volatility increase. Now in the oil market, what's causing this? Is it the price supply dynamic that's going on because
Just going to ask that, yeah.
Is it the Saudis, dumping more oil? I mean, I remember reading something on Bloomberg about the Saudis are now thinking about dumping even more oil on the market to try to hurt the frackers.
Well,
because oil seems to be stabilizing at around $50.
From what I heard in the last few days of the States with the fracking now is up to potential of 9 million barrels a day. I mean, that's absolutely huge numbers.
Right. So what the Saudis are trying to do is just dump oil in the market to crash the price, to kill the oil, the small oil, what do they call them?
The independents.
The wildcats in the United States.
Yeah.
What
I was going to say, from what I understand on the political front or on the private equity front, a lot of the hedge funds are ready to deploy cash to come in and save them, but right now they're just bargain hunting. But if there's enough opportunity there, no matter what country does, whatever they want, there's still going to be that private equity. I mean, it's an absolutely huge number that the private equity and hedge funds can deploy to save these smaller independents and keep them in business. So politically, whatever they do internationally, these guys are going to be around no matter what. And the upward mobility of having a capacity of up to 9 million barrels a day, no country can compete against that. I mean, I was just blown away on that number.
I think cheap oil, like, we talked about this a few weeks ago. I'm very bullish on America, and partially for two reasons. One is cheap energy, and two, we got a lot of tech that's going online here.
Yeah.
That's that's gonna, I think, revolutionize the whole economy.
Yeah, that's already underway.
Yeah, so I'm very, very bullish on it. I think the United States is in a good position. But like one of the attendees said, how do you protect for downside risk? Because there's a lot of geopolitical things going on.
Yeah.
Might upset the apple cart a little bit, but long term wise, I think that equities will do very, very, very well.
I mean, from a political front, I just think we got to get rid of this Greek story. Once we get rid of that uncertainty, I think things will come around fast and furious, because that's the only weighing factor out there. I mean, when you look at Russia and Ukraine, it's not a concern. You're not even hearing about it as much in the news as you were a few months ago. So
Right.
once they clear up that and there's more clarity in the market with what's happening to Europe or to Greece, I think things will get better over the long run, I think.
Well, if oil stays low, then Russia's probably going to have financial problems.
I think, well, I've been also hearing, though, that there's a couple of, I think the company's called VT Capital. They're doing quite well in Russia. So, I mean, there is quite a bit of private investment going on in Russia that you don't really hear about. And I think that that's a sort of financial system that'll keep Russia afloat. It's not the government, but it'll be some kind of private equity that'll keep certain businesses intact. So,
Right.
In terms of the war machine with Russia, who knows? I mean, there's nothing we can do about that. But I mean, I don't think there'd be. You'd be hearing it more often out of Ukraine. We're not hearing that as much. So, as far as I see it, it's not much of it as a concern. But as you said about the U.S., I think they are on a huge, some kind of rebound of something, and it's not going to be the government, it's not going to be the political system that'll keep them going. It will be, as you said, the technical. It will be definitely the oil play,
Right.
and probably there's going to be resurgence of manufacturing in the States as well. Here in
There's a high correlation. There's a high correlation when oil is lower. When energy is cheap, that manufacturing does very well.
Well, some of the other reports I've been getting, we're not talking now, but we're talking within 5 years is the time now is to get into solar energy. It's just like the solar's getting big now with what Tesla's doing with this new gigafactory and bringing out these new home batteries. You know, energy. I don't like the traditional way of looking at energy with natural gas and oil. I think it's going to change as more and more companies are looking into supplying like large batteries to be a whole energy supply for a home, let alone a car can run on. I mean, Google's getting in on it, Apple's getting in on it, so I think that's going to change everything.
Right.
Exactly.
Exactly.
And that's all technology, as you said, right?
Right.
So, I mean, you look at the numbers with Apple today; they're going to be on fire for a while. If it's not going to be an iPhone or whatever new product, you know, they got the Apple TV, then they got this new car coming out. I mean, it's just they're revolutionizing industries. These companies,
right?
You know,
I totally agree.
So
it sounds like you're a bull.
Yeah, no. I mean, you know, I am somewhat concerned about U.S. deficit. I mean, it's at 18, 19 trillion. I am worried about the next president, what the next president will do. But from an economic point of view, I think the U.S. is definitely on fire and will be on fire for a while. But if anything will happen on the negative front, it will be definitely a political system that will kind of bring it down and kind of like kill all that confidence, especially if something from the Fed level, you know, with inflation and it's just so many uncertainties out there. But I think that as long as U.S. industry and U.S. innovations there to drive forward the economy, they'll be fine. It's just if anything brings it down, it will be definitely the political, you know what I mean?
Yeah. I agree.
Because when you look at, I mean, I don't want to get into political, but things I'm hearing with what Aunt Hillary's saying, it scares me. And you know, this regulation is just going to kill it. And, you know, I'm sure you heard about HSBC is now threatening to leave London to go to Hong Kong if that Labour dude gets in. You know, things like that. So... You know, you look at what Amazon did. I mean, they threatened to say, "Oh, you're going to regulate our drone program and our testing of drones." Okay, well that's fine. We'll take it to Canada and do all the testing in Canada. And that's what they threatened, and all of a sudden the FCA or the suddenly said, "Yeah, sure. Here's the things you can do with drones." After a couple of weeks of that,
right?
You know what I mean?
Right.
So it's a tit for tat. It's just industry indirectly controls it all. You know?
I agree. I totally agree.
Yeah.
You know, with Hillary, you know, she's going to be, you know, progressive because she's in the primary.
Yeah.
You know, she's running the primaries, and in the primaries, you're always playing to, you know, the establishment. You know, for her, it's the Democratic Party. So
yeah.
She's not playing to the centrist, but she's playing to the left.
Yeah,
it's just to win the primary, and then when they go for general election, you know, she'll probably move a little bit more towards center, or maybe left to center. But
well, she has to. I mean, look at I used to kind of like Obama when he came out, but he's just now an old man, just droning away about this and that, and the regulations he's brought in that killed a lot of the banking and whatnot and other things. It's just I personally think that Hillary's going to kind of follow in those footsteps somewhat.
Yeah, but you got to remember her son-in-law is a hedge fund guy.
Yeah, well, they all are.
I mean, you know, how much is what she's saying versus how much what she's really going to do?
Well, as soon as she announced, within a few days, she was just going on about hedge fund managers are evil people, and it's like, you know, you're coming from the world of wealth, and your husband's charging $200,000 to do a speech. You know, I just that type of talk doesn't wash with me too well.
Right.
You know, and I think she's going to get a lot of, you know, a lot of votes just to be anti-Republican. I mean, I'm not a Republican either. I'm like as you say, a centrist. But either one, Republican or at the end of the day, everyone has to work together from the Congress all the way down to the the presidential administration, and that's why things are broken now. They're talking about there's going to be another sequestration in the fall, and I heard in the report of the last one when the Congress stalled it, over 750,000 jobs were lost when they did that, and it was only shut down for a couple of weeks.
Yeah, yeah.
I mean, who in their right mind would allow that? You know what I mean?
It's crazy. It's doing more damage than than they understand.
Yeah.
I mean, I knew some people that were in the defense industry that were hurt by that sequestration.
Yeah. Yeah. I mean, on the other hand, the military it's a machine, and it takes up a huge budget of the total U.S. government total budget. You know. I mean, I was hearing that was the F-35. They were spending something like $350 billion on that program. But you go ahead.
Does anyone else have any additional questions?
Yeah.
That are related to surface modeling or the market or
just general comments or concerns? I could go on about it. You know what I mean?
Well,
Anybody else? Just keep it focused, I guess. If not, Paul, another good presentation. You know, I'm learning this. I'm actually probably going to apply this framework to volatility for sure. I get your hello, Paul. Anybody else? If not, we can give it a wrap. Usually that draws out a lot of questions. Paul, you there? Paul, we can hear you, or I thought we could hear you. I don't know. Hang on, everybody. Can you hear me, Paul? Gone all silent, Paul. He's still there. Must be something to do with Time Warner down there in New York. Paul, you out there? Why don't we do this? Oh, Paul, his audio's dead. Okay, why don't we take more questions, everybody? Anybody have some questions you want to type it out for Paul? If not, we can give it a wrap. Again, thanks again, Paul, for doing everything. If not, anybody else, we'll just do it going once, twice, 3 times. If not, we'll give her a wrap for tonight. And Paul's got another one. It's May 7th, right, Paul? Is your next one? It's in 2 weeks. I think it's on a Thursday. But it's on the meetups. Okay, so let's do a going once, going twice, going 3 times. I guess we'll give it a wrap. Thanks, everybody, for coming on out. Thanks again to Dr. Paul for this. I'll definitely be implementing it. And I'll get this video up on... Yep, Paul, there you are.
all right, sorry about that.
That's
I don't know,
okay.
for some reason it just died.
Oh, weird. Made in China, eh?
Well, it's probably Hillary Clinton.
I was going to say it's the Time Warner that they're going against people in with that takeover that they got rejected on.
Right.
Go ahead, Paul.
No, I was just wondering if anyone else had a question.
Feedback, comments, anything, hate mail, love mail. Why don't we give some love to Paul? Thanks again, Paul. I'll initiate the. Everyone's all shy or something. So if anyone wants to say thanks, Paul, on the chat, that'd be awesome. No?
So I'm doing another a webinar. I think it's on May 7th.
Yeah.
It's about some of the artificial intelligence research that I'm doing, and just in the current state of the paper. I've been publishing some videos, and Brian's been helping me promote it.
Yeah, I mean,
the process that we're going through. What's going on with the paper.
I'm not sure for you, Paul, but we have Mike Barma. I don't know if you saw my announcement in the last day. Mike Barna is going to be doing a presentation on his software, the Trading System Lab. It's all based around machine learning, that software may be able to help you out at some capacity. I'm not sure, and I think that's going to be next week. I think it's next Tuesday, May 5th.
Okay.
Okay.
But I'm going to be doing some webinars, based on the research that we're seeing with the artificial intelligence, and then Francesco and I are doing another paper that's related to surfacing the bond market specifically. It's more looking at yield curves, but then turning them into surfaces, which is similar to a webinar that I did last year, but it's going to be more in this kind of format. That's more, scholarly publication. And I think the data that we're using for that is, I think it's going all the way back to 1977.
Wow.
Currents to see the movement in the actual yields. So it's a good longitudinal study.
For sure.
And it'll prove out more definitively what this research here has shown in the bond market. You'll start seeing, at least at the long level, when these types of situations are happening.
Yes.
On end of the yield curve, and we'll maybe overlay it with some intervention that took place, key intervention points with the Federal Reserve, and show how that front of the yield curve actually changes because of their intervention, and how that surface twist actually plays out over like a 6-8 year period. So it'll be a cool study. It's an interesting study. I don't know of any study that actually shows yield surfacing that goes all the way back to 1977.
Wow. Are you also looking for any kind of like economic patterns related around it at all?
Well, yeah. I mean, the economic pattern would be, with how's interest rates related to the yield curve.
Right.
Is there some? Because they're going through the high interest rate period of 1979, 1980, and the whole normalization of.
Yeah, Paul.
Through what happened with Lehman. So it's going through like 3 major economic epochs.
Right.
So
I mean, it'll be pretty powerful if you could be able to time it.
volatility, but for yield.
Right.
Yeah.
So has anybody got any last parting words at all? Maybe not. Guess nobody's got anything. Okay, Paul. Thanks again for doing this. I'll get this video up on my YouTube, and we'll figure out how to deploy it. Again, thanks again, Dr. Paul. Appreciate it. We'll see you on the 7th, I believe. If you want to come out to other ones as well, anybody else, more than welcome. Thanks again, and I'll bid adieu. And thanks for everyone coming out. Sorry, I missed that, Paul.
No, I just said thank you.
Oh, no worries. Thank you for putting all the time into it as usual. Okay, so any parting final words at all? If not, we'll just give it a good night to all. All right, so I'll stop the recording, and thanks again for everybody. Have a good night, and hopefully we'll see you on the next one. I'll be doing one tomorrow as well. Have a good night. Thanks again, Paul.
Bye.
See ya. Bye. Bye, all.